Welcome back to the Growth Stack Live, where we unpack what's actually working right now for service-based business owners scaling in the AI economy. This isn't theory, it's the real patterns we're seeing from inside the Growth Stack each week. This week's issue is called The Silent Partner You Never Agreed To. Before I ever built a company, I spent years in the investment business. That world teaches you to obsess over tiny numbers. People argue over 0.5% of return. They compare advisory fees. They read investment statements line by line because they understand something incredibly important. Small numbers compounded over long periods of time become very big numbers. Then I became a business owner, and I watched something that honestly still surprises me today. The very same people who would spend 20 minutes debating investment fees would write a much larger check every single year without ever questioning it, not because they were careless, because they assumed there wasn't a decision to make. They believed their tax bill was simply the number, calculated by someone else, delivered as fact, end of discussion. But that's not how it works. Now, if you're not already getting the Growth Stack in your inbox, the link's down below. Every Thursday, we send you a deep breakdown like this, plus 3 curated reads on business growth, wealth, and peak performance, and our implementation blueprint where strategy meets action with simple steps to apply what you just learned. Here's a question I love asking business owners. How much federal tax did you pay last year? What's interesting isn't the answer, it's the pause. Most people can tell me exactly what they spent on ads, their close rate, their monthly recurring revenue, their cost per lead. But when I ask about taxes, the response is almost always, I'd have to ask my accountant. Think about that for a second. For most successful business owners, taxes are the single largest expense they'll ever have. Larger than payroll, larger than rent, larger than software subscriptions, larger than almost every other expense combined over the course of a career. Yet it's also the expense they understand the least. Here's the distinction I want you to remember. Filing taxes is not the same thing as planning taxes. Your accountant files the return. That's looking backward. Planning happens before the year is over, while you still have decisions you can actually make. And that's where I see most business owners accidentally leave money on the table. The first decision is how you pay yourself. A lot of owners simply transfer money out of the business whenever they need it. Simple, flexible, easy. But depending on your situation, it can also be expensive. For many business owners, an S-corporation election combined with paying yourself a reasonable salary can significantly reduce self-employment taxes. Not for everyone. And it absolutely needs to be reviewed with your CPA, but for the right business, we're often talking about thousands of dollars a year. The second decision is what you do with that salary once you've created it, because now retirement planning starts to matter. A few weeks ago, I wrote what I believe is one of the most important wealth-building newsletters we've ever published, called The Second Business You've Never Run. The entire premise was this: what your business isn't your only business, your personal capital is a business too. And most owners never manage it that way. I talked about retirement accounts, investment buckets, and why every dollar leaving your company should have a job waiting for it. One thing I want to clarify from that issue, for many service-based business owners, a solo 401k often creates more flexibility than a SEP IRA because it allows both employee and employer contributions. The exact numbers depend on your income, entity structure, and current IRS rules, which is why this is always a conversation to have with your CPA or financial advisor. But here's the bigger lesson. None of this is about finding loopholes. It's about making structural decisions before the year ends instead of wishing you had after it's already over, because that's the mistake I see every single year. Someone sits down with their accountant in April, looks at their tax bill, and asks, what could I have done differently? The answer is almost always, a lot. But we needed to make those decisions last year. That's the painful part. The conversation happens. It's just 1 year too late. So here's the bottom line. Before you spend the next 6 months trying to squeeze another 5% out of your marketing, make sure you're not losing 10% somewhere else simply because nobody ever showed you the options. Sometimes the fastest way to build wealth isn't earning more, it's keeping more of what you've already earned. So I'll leave you with this. If I asked you right now exactly what you paid in federal taxes last year, could you answer, or would you have to ask someone else? Join 15,000 plus service-based business owners who subscribe to the Growth Stack, your weekly AI playbook built for action, AI strategies, implementation blueprints, and the tools you need to grow in the new AI economy. We stay ahead of the AI curve so you don't have to. Access all past issues and subscribe for free at www.thegrowthstack.info. Hit the link below to subscribe, and I'll see you next week.